the fact that it is this BVX, our Bitcoin Volatility Index, that it's based purely on data sourced from a CFTC regulated, DCM, CFTC regulated contracts. The regulated angle of this index will open a lot of doors within the traditional institutional space. So I think this is to some extent what the market has been waiting for when it comes to, unlocking the volatility spectrum for crypto, for digital assets, is that you now have an index that you can properly rely on from an institutional perspective.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. Hey everybody, thank you very much for joining us for another episode of CFB Talks Digital Assets. I'm Ken Erdösi, Head of Content, and I'm joined, as usual, by my colleague, Gabe Selby, who's Head of Research. Hi, Gabe.
Good day, Ken. We've got probably a little bit more of a wonkier episode today, right?
Yeah, well, they're all kind of wonky, but yeah, maybe slightly, but nevertheless, still very interesting, I hope.
Yeah.
Right. So, yes, and the reason why Gabe says that is because today we're pleased to be joined again by our Head of Product, Thomas Erdösi, for an illuminating look under the hood of one of our newest and most exciting regulated benchmarks, the CF Bitcoin Volatility Index. There's a settlement rate and there's also a real-time version or variant. We call the Bitcoin Volatility Index settlement rate the BVXS for short. And not forgetting the real-time variant, the CF Bitcoin Volatility Real-Time Index, which we call BVX, just BVX. Now, the main thing to remember about these indices is that they represent the first comprehensive benchmark of CME Bitcoin options implied volatility. And one other thing I wanted to say was that throughout this sort of conversation, we'll be referring to BVXS and BVX. We're talking about the same essential methodology. So basically, we're going to obviously talk about our new index, but we're also going to talk about volatility in the broader sense to enable us to have a deeper understanding of why we've actually launched this index. So Thomas, thanks a lot for joining us again, and we're looking forward to this conversation.
Thanks a lot, Ken, and thanks, Gabe. Very happy to be here with you guys.
We've already said that it's a volatility index, and one thing we need to be clear about is that it is, of course, implied volatility, options implied volatility we're referring to. We're not talking about variance. We're talking about historical or realized volatility. And that obviously brings us into a frame of mind of noting that we are utilizing volatility in the traditional market sense. And that's sort of a way in to think about our new indices. So I'd like to pass this on now, Thomas, this section to you to talk about the basics. If you could run us through some top line specs of BVXS, what would you actually offer us on that respect?
Sure. So as you already alluded to, it's really designed as a measure of how volatile spot Bitcoin as the underlying asset will be over a given time period. So in our case, it's a 30-day forward-looking constant maturity measure of volatility, as opposed to a realized volatility, which is obviously backwards looking. So it's a measure of what we think is likely going to happen, how dispersed Bitcoin returns will be over a 30-day period.
We've mentioned about the fact that there are two variants, real-time and sort of settlement. That's pretty clear. Now, do you want to talk us through some further details about some concise methodological points? Still being mindful of the fact that we are trying not to be too abstruse. Can you give us a technical description?
You can be abstruse if you need to be. I think.
Yeah, sure.
If you have to do it, you just got to do it,
Yeah. One aspect I wanted to sort of maybe zone in on as a way of getting into this. The description on our index page, which you can find on cfbenchmarks.com, of course, is that the BVXS prices the fair strike of a 30-day variant swap in the sort of underlying. Now, if you were to put that into sort of like slightly less technical terms, how would you actually do that, Thomas?
Sure. So first of all, before I begin, let me just say that, as usual with CF Benchmarks, all of our methodology documents are publicly available on the CFB website. So if any of what I'm going to say doesn't make sense, you can always go back to that. Now, with regards to this fair variance swap strike pricing methodology, what this really means at the end of the day is that the methodology is based fundamentally on the pricing of variance swaps. Now, variance swaps are a product well known in traditional finance. It's essentially an OTC product whereby one market participant will, with another market participant, exchange realized variance for a fixed variance. And there is a specific pricing methodology associated with that, which can be used, or which is quite representative of volatility markets in total. And that's what's commonly known as this standard market approach of creating volatility measures. And that goes across all asset classes. So as I'm sure you know, the original, the CBOE VIX index, the S&P 500 VIX index employs the same standard market approach. And what that really entails is effectively it's to gather data and information from all available options contracts in the market. So in our case, our Bitcoin Volatility Index is purely based on CME options data. And what we do there is we aggregate all contract data across strikes and across tenors. And what we do is we bring that together through a weighting and interpolation methodology to bring out that measure of volatility.
I think I want to stick to that point just for a second. Ken, you said something, up front where you were talking when you were first describing the index as a constant maturity. And Thomas, you might be able to kind of just add a little more color to, why is that so hard when you're trying to create like a constant maturity measure of something? If you think 30 days out, a listener might be thinking, well, I could probably do that. I just look out 30 days and I can probably calculate my own little variance swap index. But if we're being honest, it's quite a challenging task. It requires a lot of, I think, mathematics. And if you're able to just kind of dive into that to kind of create that constant maturity stream that the index uses.
Yeah, absolutely. Good point, Gabe. So the issue you have, especially when it comes to exchange traded contracts, is that there is no such thing really as a constant maturity futures product. So there are fixed expiry schedules when it comes to CME futures and options, and CME futures traditionally expire on the last Friday of the month. Now, you will have for each month a different contract. However, that expiration will never be exactly the 30-day expiration, looking from where you're standing today, right? And as such, there is always a need to interpolate between different contracts, different maturities to arrive at that 30-day constant maturity measure. That's part of the complication.
Yeah, this is one of the ingenious aspects of the methodology, that it's essentially achieve something which is kind of difficult, maybe impossible to actually achieve individually, or even maybe even automatically if you're not really careful about how you go about it. So that's one thing we've covered off. Before we dive a little bit deeper into the mechanics, there's a couple of other essentials. We've dealt with the fact that this is only based on CFTC regulated CME Bitcoin options. That's great to have. The other point I wanted to sort of like really clarify totally upfront is the publication times. Now, obviously the settlement variant is published at 4:00 London time. That's the once a day measure. But then there's an interesting publication sort of like a time, if you want, for the real-time variant, Thomas. I'll tell you, it's basically 0700 to 1600 US Central Time for the real-time variant. Why is that the case?
Yeah, good question, Ken. So taking a step back, when it comes to the development of indices here at CF Benchmarks, we always strive to abide our 3 R's whenever we build and develop indices. That's part of the CF Benchmarks ethos. And those 3 R's are representativeness of market reality, replicability, and finally, manipulation resistance. And the reason for those publication or those observation periods is mainly around replicability. So we do find that especially for the daily close, which is based, like you said, on the 3:30 to 4 o'clock London time window, is just usually the most liquid period of the day, whereby we as a benchmark provider can be confident that replicators of the settlement rate will not incur any undue costs during that period, and that just the liquidity picture is very strong, and so as such the integrity of our index is maximized.
Perfect. Couple of other things. We can sort of deal with this in a sort of cover-all way, because you talked about the 3 R's, which essentially address safeguards, replicability, representativeness, very broadly speaking. Now, I want to talk about 2 other points on that specific front: the exclusions, the conditionality regarding the input data. Because I understand that there are some instances of contracts which are excluded if deltas below a certain threshold are excluded, and values below a certain liquidity threshold are also excluded. If you could just talk to that as well, just very briefly, that'd be brilliant.
Yeah, absolutely. So while I did mention earlier that the standard market approach is in line, or the approach we use is in line with the standard market approach as used by the S&P 500 VIX, crypto digital asset, the space is still fairly nascent in its nature, and there is, as we found during the research and development process, there is a need for certain adjustments to really to cater to that fairly unique liquidity picture in terms of market structure. So what we've done, for example, is when we look at building basically the volatility surface, so when we aggregate all those different options contracts, we actually trim the surface to exclude very low delta options. So those are options that basically have a very low probability of ever ending up in the money. So that's a low delta option, and we trim those. So basically, we exclude them from the calculation if that delta is below 5. Now that is fairly standard actually in the crypto space, in the crypto ecosystem. And it makes sense just because those types of contracts, those order books tend to be fairly unstable. Those are effectively lottery tickets. And given how volatile crypto prices are, you can imagine that those order books just jump around quite a lot. And that's not really the kind of input data that you want to use for calculating and publishing a robust regulated index.
So just for our listeners, when you say lottery tickets, we're talking about options that are really far out of the money. Like maybe they're just very low probability strikes given the fact of where the current price is. And that is something that we as CFB are considering and excluding to kind of create a more consistent measure, right? I wanted to kind of jump back into one small point, which I think is a big deal. And that's the fact that this is using the CME's options, right? So if you look at how this volatility index maybe compares to other Bitcoin volatility indices in the market, ours is very exclusive in that way, right? Right, Thomas? So I would like to get your take. Maybe how is the use of just the CFTC regulated input data going into the BVXS from the CME, it's a very premier exchange. How might that impact the institutional adoption curve for this type of index versus perhaps another type of volatility index? I mean, we can kind of parallel this to what we saw in the futures market, right? Where we've seen, I think it was Binance who dominated a lot of the futures volume activity. But as we've seen more institutional adoption, the CME at one point has overtaken Binance, I think, in open interest. It might still be number one, but we've definitely seen this type of this
institutionally. Definitely the CME would be, confirmed institutions will be number one, but more broadly,
Yeah, sure. So since the launch of this index, it was launched this year in April 9th, we've seen significant amount of interest from institutional players in our Bitcoin Volatility Index. There are a number of use cases for it, obviously, But fundamentally, what I think people have to understand is that since spot Bitcoin ETF launches at the beginning of the year, at this point there is around 60 to 70 billion dollars in Bitcoin longs embedded in those global ETFs and ETPs. And it's just very clear to all market participants that from this, there is a need for, managing the underlying volatility. We have to be real about the fact that due to, which is just in Bitcoin's inherent nature, is that still realized volatility, it's still, around 50% plus. And there is a need for products that helps institutions navigate that uncertainty. And that's certainly the feedback we've been getting.
I think now is a ripe time to move things on into understanding the BVXS in the broader volatility context, if you will. Because so to really drive home the need for a specially designed Bitcoin implied volatility index, we'd now like to look at the rise of the CBOE VIX, which everyone knows about. It's probably the most famous volatility index in the world, and maybe speculate on the possible future parallels with BVXS. So, and I think, I'll hand this over to Gabe and of course Thomas to actually do that. So, Gabe, how would you like to get into this section?
What Thomas kind of closed off with last time is a good way to kind of maybe put this on to a bigger perspective. So if we look at the volatility, the realized volatility of Bitcoin, we know it's some multiple magnitude higher than the equity market, right? And as we see more and more allocation strategically into Bitcoin, like Thomas was saying, we're seeing, tens of billions of dollars now in notional spot long Bitcoin exposure. There's going to be an inherent demand, inherent need to navigate this volatility landscape. And what the VIX did is it kind of gave you, I think, a deeper understanding of where market positioning and sentiment is in any given point in time. So, for example, if you study maybe the volatility index, the VIX on the S&P 500, you'll kind of see a bias towards paying for insurance. So you typically see more premium or implied volatility on the put side versus the call side. And the VIX kind of breaks that down so you can kind of see that in what's called the volatility smile, which is, it looks kind of just like a smile, and that's why people call it that. But you typically see that the put side is just a little bit higher than the call side. And during periods of, exogenous shocks or black swan events, you see that jump up even higher. Now, for an asset like Bitcoin, which again is something that's a lot more volatile, there's really nothing out there, or there was nothing out there for practitioners, for researchers, for investors to dive into and see. So it's really been, I think, monumental in that aspect, right? To give people more confidence in navigating the volatility landscape. Wouldn't you agree, Thomas?
Yeah, definitely. I think, look, it's just pretty clear that the volatility spectrum, it's just one of those missing pieces of the puzzle. And that was the case back then with the CBOE VIX. And I very much see it as, this being the case now with Bitcoin volatility. I mean, there continue, especially in the crypto ecosystem, to be other puzzles that are missing. We're talking about, for example, interest rates in crypto, swaps in crypto. But certainly volatility is front of mind for a lot of market participants. And the problems that the CBOE VIX solved back then and continues to solve today, CBOE VIX futures, options, and also ETFs and products around the world, they carry significant AUM and they perform a really critical function in the market. And it's no stretch to forecast that Bitcoin Volatility Index futures and other products will serve the same purpose in the future.
Maybe like just for entertainment's sake, going back to this constant variance swap, that meant that you had to create this thing called the volatility surface, right? And that's something that if you're in traditional finance and you like to trade options or use options, you use this thing, you go out, you look at it, you pull it up maybe for an individual stock or maybe even for the S&P 500 through the VIX. and you can kind of see where is the market kind of paying more or less depending on like the duration on different strikes or maturities. And so this was an exercise that your team had to do. It's something that we now publish on our website, so we can put a link and we can probably show it here for the viewers. But it's something that's really cool because you can kind of see some of these natural biases, these tendencies that you're seeing in the CME Bitcoin options market, right? And maybe walk us through of like what are some takeaways that you've learned so far on constructing this type of volatility service?
Yeah, I think one of the key use cases really for volatility data in general, but the BVX in particular, is the sentiment gauge avenue. And particularly volatility surface data is useful from that perspective because it gives you some type of indication of how market participants feel about, the current state of play in the crypto ecosystem, but also how they feel about general macro events, for example, how do they feel about the Bitcoin halving? You could kind of really see market sentiment around those events just measured by the volatility surface and how it moved, before event, pre-event, and post-event. You can assess things like market skew. So are market participants willing to pay more or less for, top side out of the money options? So that's out of the money options that are like, around 100,000 plus in Bitcoin, basically, or are they looking to hedge the downside? For example, by buying put options around, let's say, 30,000 or 40,000 strikes. So all these things you can visualize in a surface, and you can hand it out to different, market participants, and it helps them to sort of form their views, and also then to, either trade on those views directionally or to place appropriate hedges in their existing portfolios.
Perfect. And that is, I'm loving this conversation because we've actually had a natural conversation. I don't want to say for a change, but we had a natural conversation that's actually progressed, in a sort of like logical way as well. We have obviously moved on to use cases, and you've talked about sophisticated sort of options and volatility trading with respect to the volatility surface. But of course, there are other more banner use cases as well. I think let's talk about those. The preeminent one being, of course, that we expect at some point some body or some party to launch a volatility product based on this volatility index. Although we need to be clear at the moment, there are no actual products that reference the BVXS. Of course, that's going to change. But run us through, guys, these sort of like headline use cases, and how you'd like to expect them to play out in some tiny bit of detail from here and there.
Yeah, so I think from our perspective, this sort of tail risk hedge type of use case, the type of use case where you can add products that references Bitcoin volatility to an existing portfolio that might be a crypto portfolio or even a cross-asset portfolio, is clearly what the market is, sort of the direction of play in the market at the moment. There are plenty of other use cases, though. Also bearing in mind that, sort of this fear greed gauge attribute of volatility indices is not always as reliable, and it's not strictly proven for Bitcoin either. So I think there's another area of discussion maybe for later. But outside of that, there is the pure data element that is useful. So just having that sort of volatility gauge can help portfolio managers rotate in and out of risky assets, risky crypto assets, for example, as they see fit. And again, from a data perspective, just the surface data, this holistic view on volatility helps traders and portfolio managers alike to manage risk.
Yeah, exchange traded products as well.
Yeah, absolutely. So I think we obviously, this fundamentally is the goal of this entire exercise, to have product issued on the back of this Bitcoin Volatility Index. I mean, this is what we've always done here at CF Benchmarks historically. We are, and especially the product team, where we strive to define markets, right? And we do that through our methodologies, through that, replicability, element to make markets comfortable to issue product that will, at the end of the day, serve the wider community and serve crypto adoption as a whole.
So yeah, Thomas, it's been really great so far to listen to your background on how we've arrived here in this moment in time and getting this index off the ground and what we hope to see ultimately come to fruition. And I think what we covered initially was this whole aspect of a regulatory or a higher regulatory venue that's inputting the data into this index. So I guess, how do you see the introduction of the BVXS into the broader landscape and helping facilitate maybe more efficient price discovery in the CME options market, which from what I understand is still kind of more of a nascent place, right?
Yeah, that's true. I mean, I think overall, certainly once product is issued that references our Bitcoin Volatility Index, it will massively help to enhance the options liquidity complex, so the CME options liquidity complex. I think generally speaking, CME markets have, done a lot of, good work in a sense to catch up with derivate markets, which obviously continue to dominate in terms of open interest and volumes. Now, having said that, what we've observed, certainly since the beginning of the year, is to some extent a convergence between those two markets, meaning that, CME volumes have caught up substantially. We see efficiency from a pricing perspective has improved substantially. So we're really getting to a point where we can say there's not too much of a difference between trading on the CME and on Deribit. And we certainly get that feedback as well from our clients saying that, we would like to actually trade just on the CME just because of the regulatory angle. And that's somewhat move away from Deribit towards the CME in that sense. And that's something we at CFB are also a part of facilitating and making sure that all the rails are in place for that to happen. And obviously, our volatility index is part of that.
I think that's really interesting because it's like we're seeing these similar parallels that we saw before, perhaps in the futures market as well, right? Where we've seen, I think, the CME make up ground against its competitors on Bitcoin and Ether futures. Now you're telling me that you were seeing, the CME make up ground on the option side, and it's all. I don't think it's all unexplainable. It's not a coincidence. I think the fact that you're seeing so much institutional interest means that you're seeing so much institutional grade product being launched, such as new custodians to service spot Bitcoin futures and soon to be spot Ether futures. You're seeing more and more native crypto exchanges, such as our parent company Kraken, focus on institutional type services and products such as OTC trading, etc. So I think it totally makes sense. It's not a coincidence at all that we're arriving at this point where we're seeing these more premier venues that are more regulated kind of catch up, right, to the competitor leaders, I guess you could say, that were traditionally or initially there, right? And now you're seeing these traditional institutions kind of catch up. So I think that's something that's super interesting. And I think the BVX and BVXS is something that's a critical component to kind of helping that catch up happen, right?
Yeah, I mean, it seems to me that this follows the same motif or the same fractal as we've seen across pretty much our whole career at CF Benchmarks. We bring the institutional side into the cryptocurrency arena, and the institutions follow. It's quite logical. It needs to happen because it's a regulated space. It's basically sort of real money that needs to be managed in a way that has a fiduciary backdrop as well. So this is what we're seeing here is quite in line with that, and it's likely to be the sort of going forward an important inflection point for institutional participation. So Thomas, I wanted to say thank you very much for joining us, and I think you guys as a pair, both yourself, Gabe and Thomas, have done a really good job of breaking down and sort of digging into what could be, as Gabe said, an abstruse subject, but bringing it to life, I'd say. So thanks a lot for that, Thomas and Gabe.
Thank you very much, guys.
Yeah, and you need to come back, Thomas, because as we've said, full disclosure, We do not have any client assets referencing the BVXS at the moment, but we expect that to change in quite short order. And when that does, that will be a good enough reason to drag Thomas back on here to talk about it. So please do come back and give us an update. Exactly.
Yeah.
So Gabe, that was, I found that really scintillating, and I felt I came away with a deeper understanding of certainly Bitcoin implied volatility than I had beforehand. I mean, I know you're the expert, but
I don't know about that.
how do you feel about Thomas's input there on this new product that we've just launched?
Well, I thought it was very insightful as usual. So it's going to be very exciting to see how this index helps transform, I think, the institutional landscape, and then a very important category such as volatility. I mean, Bitcoin's a much more volatile asset that we, when you compare it to other traditional asset classes, particularly even on the risky asset side. So if you compare it to equities, so it's very it's very topical. It's very important, and it's going to be interesting to see how the shifts in investor sentiment kind of evolve as we, go through another election year towards the end of this year, as we see more and more regulatory headlines coming out of the U.S., as we get more macro data. I mean, these are all things that now we have a gauge to kind of see how the investor appetite moves or shifts around these breaking news events, right?
Yeah, and although I'm sure we've got a certain cohort of viewers and listeners that possibly have the view that, or at least maybe half, or else they wouldn't be, in terms of half and half in their mind, that we represent something like the enemy, because obviously we are the institutions, we are bringing in the institutions, But having said that, it's undeniable, isn't it? You can see the pattern for yourself. I mean, ETFs, the actual BRR itself, the very first index that is regulated to address the crypto market, and the institutional on-ramp that represented for these capital markets and players as well. So I do see this. I do like to come back to that point that BVXS and BVX, the real-time bearing, represents another inflection point of that ilk, because it's the first regulated volatility index. And of course, it's the first and will likely be the only ever measure of CME Bitcoin options implied volatility, which is, of course, the primary CFTC regulated Bitcoin options market. So I can't see how it cannot be another inflection point. I mean, I guess you would agree with that.
Yeah, totally. And so it's just going to be very exciting to see how this all develops. And as a listener, if you're still with us, I think, be sure to kind of keep a timestamp on these things, because as we get more and more adoption, as we see more and more wirehouses on board these spot Bitcoin ETFs, there's going to be this inherent demand for some sort of volatility proxy to gauge the market going forward, right? So that's going to be, I think, the way I want to close on is just, timestamp this episode, and we'll see kind of how the volatility index kind of evolves with the institutional adoption wave that we're seeing.
Absolutely. And guys, we've mentioned the volatility surface a number of times in this episode. And I just briefly want to circle back to that, because from my point of view, even if I say so myself, and obviously I didn't have anything to do with the engineering of it, but it is a masterful feat of engineering. And, you're not going to find anything, you're not going to find it anywhere else, because basically it is, of course, the volatility surface of the only regulated primary Bitcoin options market operated by the CME. And that data is exclusive to the CME. And we have access to it, of course, by virtue of the fact that the CME is one of our major partners. So if you want to look at, if you use volatility surfaces, if you're interested in Bitcoin and you're interested in this product, you need to head over to cfbenchmarks.com and navigate to the volatility tab. And you can find that volatility surface in that tab. It's definitely something that you should check out. Of course, if you do want other episodes like this, we are available on all of your favorite podcast platforms: Spotify, Apple Podcasts, Amazon, and so on and so forth. Our video versions continue to go from strength to strength on YouTube and, of course, Vimeo. And cfbenchmarks.com is the destination for all of our other content, including Gabe's quarterly attribution reports, the most recent of which was published, I think, just last week. So head on over to cfbenchmarks.com for that as well. Aside from that, we look forward to seeing you again for another episode of CFB Talks Digital Assets. Thanks for joining us, and bye.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. It is not intended, nor should it be considered an invitation or inducement to buy or sell any of the underlying instruments cited, including but not limited to crypto assets, financial instruments, or any instruments that reference any index provided by CF Benchmarks Limited. This recording is not intended to persuade or incite you to buy or sell a security or securities noted within. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making any investment decision. Some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.